So I want to build up on a conversation that we began early this morning. And this discussion, I would shift it slightly to look at the cross-border transactions in a different perspective. So as we begin, I want you to look at it from the perspective of the enterprises, the MSME. So when you look at the barriers that drive or limit access and interoperability, we are looking at the solutions you are offering. To what extent is it aligned or reflecting the enterprises that we seek to provide the solutions to? And as you'll be able to see from this conversation, the MSMEs that we'll be examining are those MSMEs that participate in cross-border trade. However, what is coming out, these MSMEs have different characteristics and attributes, which is actually aligned to the countries where they operate. And of course, we wanted to understand more from the exchange rate perspective, but we had that limitation from our end. And as we'll be concluding, one of the key policy issues that would be coming from the study would be, to what extent can we ride on existing infrastructure to improve and enhance access? So the low-lying fruit. So to take us through this conversation, so as we begin this conversation, I'll begin with the outline. So first of all, I'll paint a background and the context unto which this study was motivated. And thereafter, I'll be able to... Sorry. This is next. So thereafter, I'll be able to paint from a theoretical perspective what is driving the trends that we're able to observe, and briefly give a methodological highlight of how we're able to examine the enterprises based on our data, give a quick or high-level insights we're able to get, and then finally give the policy implications. So to begin us with the quick background about e-payments, why is it significant? At this particular point, at this decade, we are looking at fast and efficient payments. So for businesses and individuals who are keen to pursue transactions, those are the two key things that we look at. And because of that, we find that e-payments come in to be handy because it is critical in facilitating trade. It is critical in enabling MSME growth, and is also critical in ensuring that we have financial inclusion, and generally, if that transaction happens across the region, we're able to have that regional integration. Yet, we have had so much being done around this to ensure that we achieve e-payment across the region, but we still see there's some gaps in terms of being able to have interoperability of these payments. And that's why the key question that we seek to ask is, how can we, as a region, move forward to adopt systems that would support interoperability? And I want us to look at it from the perspective of the businesses who are the MSMEs. So as we look at that conversation, then the question would be, what is actually driving the adoption of these e-payment or fast payment platforms? So I want us to look at the two key theories that would actually help us understand. So the first one is the network externality theory, which actually tells us, for us both to have an adoption, we need to have people taking up a particular system or a particular platform. So when businesses, when individuals are actually picking up these e-payment platforms, it means you are going to have high adoption. And that one, we call it the bandwagon effect. So from the e-payment approach, we've been able to see the bandwagon effect, so that we're seeing businesses taking it up, and as more and more business taking up, we have now more and more adoption. However, as that happens, because we are looking at transactions happening even cross-border, we have a challenge. The issue of the transactional cost theory comes on board. Different countries, different institutions have different ways of governance. There are different players, so there are issue of costs. And now those frictions that come along now would now be able to act like a drag towards actualization of these processes. So for us to be able to do an in-depth analysis of how businesses feel and what is in the ground, we actually decided to look at the World Bank Enterprise Survey, which actually we focused on 4 countries, Rwanda, Kenya, Tanzania, and Uganda. And all these 4 enterprises from all these 4 countries are actually involved in cross-border trade activities. So why did we choose this data? This data actually, based on the survey that was done by the World Bank, it captures key issues which actually revolve around the operational behavior of those enterprises, how they use digital platforms to pay for services or to be paid for the services they offer. And then also, we're also able to see some of the infrastructural constraints that they're able to face. So for us both to now have a much deeper insight of how those enterprises are. So if you look, we have 6 charts on the board. The first one is around the sizes of those enterprises in those 4 countries. So we have the small, the medium, and the large enterprises. And what is evident across the region, most of those enterprises are small. And if you are very keen, Tanzania has the largest portion of small enterprises. In terms of the structure, the registration structure, most of those enterprises are sole proprietorship. So what I'm actually trying to paint is a picture of like, how are those MSMEs characterized, so that once we have that understanding, we now start interrogating the kind of solutions you are offering and to what extent they are able to reflect or can be able to solve the problem that these MSMEs are facing and how they align to their business. So in terms of registration, you can see most of the enterprises are sole proprietorships. And if you look at Kenya and Rwanda particularly, you can find the largest proportion of them, they're the ones which are leading in terms of the proportion. And what is even interesting, for Tanzania, we have most of them having shareholding, which I don't know why, but I think I'll be having a conversation with my brothers from Tanzania to understand what could be driving that aspect of that particular registration being so dominant in Tanzania, which is actually contradicting to the other regions within the EAC. And then the third aspect that we look at is the age of the enterprise. Because the age of the enterprise speaks so much about its capacity, its muscle, and its willingness to be able to evolve and adapt to the existing business environment. And what you can pick from this, most of those enterprises are ranging from young to mid-level. So if you look at a country like Rwanda, most of them are in that young category, whereby around 60.8% are less than 10. Around 60.8 are less than 10 years since they were formed. So, of course, the age of the enterprises tell us more about the extent to which they can be able to maybe take up this new opportunity, because now once they adopt some of these payment platforms, there's a cost to it. So older businesses tend to have that much bigger financial muscles compared to young enterprises. And then the other aspect that we look at is the aspect of internet accessibility. So if you remember from the earlier conversation we had in the morning about the last mile access, there was something that came up about offline execution of transaction. And I feel that aspect really aligns so well with the aspect of internet connectivity. Because if you are looking at e-payments, and internet is one of the key aspects we need to look at. So definitely, if you don't have access to internet, the chances and the probability of you being able to adopt or embedding it into your business is significantly lower. So that's why it's a very key indicator that we look at here. And then the next aspect, the next chart that if you can see from the aspect of internet, we can see that in Kenya, though there's a notable share of firms that still report occasional internet disruption. So it's evident all of them have access to internet, but that aspect of disruption is an issue. So the next one is in terms of banks-based payment instruments remain more important in Tanzania. So that chart, we are simply looking at which payment instrument do they prefer. So we find bank-based instruments, they are mostly preferred in Tanzania and Uganda. So that one really tells us about the solutions that are aligned to specific countries, and how, when we move to interoperability frameworks, how do we come up with solutions that are very much aligned to specific countries and the specific enterprises? So to be able to dig deeper and understand what is happening to these businesses, we decided to go a bit deeper in terms of econometric approach. And first of all, we asked ourselves, an enterprise will have to make a decision as to whether they are going to use or fail to use e-payment approach. So that is the first step. So for those who decide to use the e-payment approach, there are two options that they have. There are those who will adopt the card-based approach, and there are those that would prefer to use non-card-based approach. So among those that will go for the non-card-based approach, there are those solutions that are offered by the banking sector, and there are those solutions that are offered by the MNO. So that's basically the framework that we actually use to dive deep to understand the drivers to access and interoperability and the challenges that these enterprises face. So the approach that we use is called the Heckman sample selection methodology, which for those who are in the subject of econometrics, you know, because this data was already collected, it was pre-collected by the World Bank, we did not have control. And as we do now that categorization, we introduce that aspect of biases. So this methodology is robust enough to be able to address those biases. So we did the model, and for the comfort of the non-econometrician, I've not been able to put here the tables. However, the full table and the details are in the actual paper. But here I'll just take this opportunity to highlight the key results. So from the first aspect, where we're looking at the decision to either use e-payment for cross-border purposes or fail to use, what came out so strongly is that internet connectivity, the cost of the transaction, and the country-specific effects are key determinants in influencing the decisions as to whether an enterprise would be able to adopt or fail to adopt. And I feel this aspect resonates so well with the last mile conversation that we had earlier. And that's why when you look at it from a policy perspective, how are we going to address this issue of internet connectivity? Because all countries within the region, we are still struggling in terms of being able to have internet penetrate in virtually all the regions. So as we look for solutions, that's one of the aspects we need to look at. And then if you go deeper, you find, like when we were doing the model, Kenya was used as a benchmark, and then the other countries were being assessed relative to Kenya. So those country-specific effects, now if you compare, for example, Rwanda and Kenya in terms of adoption, so you find that 33.9% in Rwanda, 33.9% is less likely to adopt e-payment. So if you compare a firm that is operating in Kenya and Rwanda, so there's that less likelihood of a firm in Rwanda adopting the e-payment approach compared to Kenya. So those are some of the country-specific effects which we are talking about being influenced by the internal business operating environment. So for example, if you look at a country like Uganda, you find that difference is significantly less compared to Kenya. So that's about adoption and fail to adopt. And when you look at solutions to be able to incentivize these enterprises to come up and take some of these solutions that we can encourage interoperability, these are some of the key issues we need to look at. And then the second aspect was, after we've been able to decide to use the e-payment approach, so now the choice would be, are you going to use a card-based or a non-card-based? So on top of the card-based approach, we are looking at things like the MasterCard, Visa, and all that, or we are going to use any other solution that is not card-based. So also, you can see from the results, among the firms that are already using e-payments, Rwanda, the high percentage points are more likely than Kenya to use the card-based payment options. What does that say? It simply speaks to the environment or the business environment within Rwanda, which we are trying to say, each country has unique features that actually incentivizes the businesses or enterprises within that country to adopt a particular framework that will be suitable to support its business. And that's why we are seeing some of those differences. And then at the last stage, when you're looking at those that have decided to go non-bank, non-card-based, there are those solutions that are offered by banks, and there are those solutions that are offered by MNO. So now, among those who decide that they are going to use e-payments that is non-card based, we see that firms in Rwanda and Tanzania are significantly more likely to rely more on bank-based payment channels as opposed to firms in Kenya. So the question would be, how does that resonate or reflect around the businesses in Rwanda, the regulatory environment? What is so special to encourage the businesses in Rwanda to stick to the banking system, and yet we are seeing the positives that will come along with these other MNOs? So that is one of the things that we need to look at. And finally, what I can conclude from this discussion is that Tanzania and Rwanda, they are heavily dependent on the banking system. So if we are looking at solutions that will be able to encourage interoperability, how are we going to work with the banking system so that we now come up with products that are well aligned to meet the needs of these businesses? Because ultimately, we need to solve their problems so that they can have that high adoption. And on account of this conversation, we come to a few policy recommendations around that. And one of the policy recommendations that we would like is, given that we are seeing there's more utilization of bank-based solutions, how can we be able to harmonize some of the regulatory checks, the KYC, the anti-money laundering and combating financing of terrorism? How can we be able to harmonize across the region so that now we can have those enterprises now be able to seamlessly work with the current system, and then as we now move towards the digital side, we can now be able to build on that success. And then the other aspect is in terms of the infrastructure. How can we be able to raise the infrastructure to a level that we have a common operating infrastructure that will be seamlessly used across the region? Like we talk of the ISO 20022, how can each country across the region be able to elevate itself to ensure that they've been able to adopt that system so that the systems can be able to talk to each other and successfully conclude the transaction? So those are some of the key issues that we are trying to say. Let's get solutions that are well aligned with the businesses that operate in our countries. And the first and easiest way to do that is to start with the low-lying fruits, which entail harmonization of those particular regulations and systems so that now it can become easier. Thank you so much.
Thank you. Thank you so much, Mr. Hilary. Even before you go, I think we can leave room and see if we have questions. Maybe we can take one or two questions before we move to the next presentation. Do we have any contributions? Do we have any other person? Okay, we're going to take...
Yeah, I thought you said we take it at the end, but let me take it while it's hot. So, the issue of interoperability and the link to the dominance of the players in the ecosystem. Does your study in any way make a judgment as to whether interoperability addresses competition dynamics that could actually affect the cost element? Because one of your recommendations is really reducing of costs. And if you have dominant players, that has an implication on cost, and therefore interoperability is assumed to offer an element of competition that will actually put pressure on costs to come down. If not, then what specific thoughts do you have in terms of reducing the costs? That's one. The other is the issue of the payment systems and how those systems can allow the capturing of informal trade. Because you're talking about SMEs, some of which are operating informally, and how do you capture that? Because if you want to have an idea of a proxy for informal trade, look at what country A says it exports to country B, and what country B says it imports from country A. There's a difference, and that's really how you capture informality. That's from a trade standpoint. How do you capture that from a payment standpoint? Because a huge chunk of it could actually not be captured in the survey that he talked about. I think those are the two issues that maybe you can.
Thank you, Jared. So on the first one, the issue of dominant players is something that came out so strongly when we were doing the literature review, and we actually captured that aspect when we actually noted that the government might be keen to push for interoperability, But in the event or in specific countries where we have dominant players, they would really try to stifle that process, because the moment interoperability is achieved, it means the other players will be gaining an advantage. So from a policy standpoint, it's something that has to be pushed from the government side. But in the analysis part, because we are actually using a survey data that had already been done, we did not capture it within the study. And then it's also interesting to look at that aspect of informality. I think that's one of the aspects we should be able to incorporate and improve the paper, so that once we share the final paper, we're able to link the two. And then finally, on the cost bit, how it can be able to be addressed. The way we had earlier conversation, this is an infrastructure, and the industry need to agree to share the infrastructure. And the governments have to be at the forefront. So one of the things that actually raises the costs is the issue of taxation, the issue of compliance. So once we have harmonization, I think that's one of the starting point to be able to work on the aspect of cost, because if we reduce the cost of KYC, if we improve the cost of compliance, which goes along with those platforms, we'll be going a long way towards minimizing the cost. And then also the issue of taxation. So to what extent can the government compromise the revenue that they seek to raise from this platform, so they can also encourage adoption and usage? Because we believe this is the only way to have more inclusive access in the financial sector.
Thank you. Thank you so much, Mr. Hillary. There was another contribution. Yes, if you could kindly keep it short, so we're pressed of time.
Thank you. The presenter was okay. But one thing is that on the countries picked for study, Kenya, Uganda, and Tanzania, and Rwanda, first of all, I would like to understand, why did you pick reference all the countries referencing to Kenya? Is it because of advancement in that channel of payment? Two, I would like to know, you made the abbreviations you put there, KYC, IMED. What do you mean by them? Are they the same errors in all the 4 countries in terms of regulation in combating anti-money laundering, or in some regions maybe they are more advanced, such that you could have been based on them to make reference to Kenya as opposed to other countries you used as your case studies? Am I clear?
Yes. Okay, thank you. For the first question, in research, we have various approaches that we actually use to undertake studies. So for the approach we used in this study, for you to be able to see the impact of an observation, you compare or benchmark with one of the countries. So in this case, Kenya has been cited as a global leader in digital, and we felt comparing how far these countries within the region are or close to Kenya can be able to give us a gauge of how we can be able to assess. But that does not mean that it is only Kenya that can be used. We could even have used Rwanda, Uganda, or Tanzania. The insights would be the same, only that now it will be now based to a different reference country. And then in terms of KYC, in full is simply know your customer. So before you transact with any financial institution, they need to have particular information that identifies you. So it's simply a term that we use to give to the particular information that your customer gives to the financial institution, so that now the institution have a clear picture of who you are. Thank you.